Recessions are the best time to become wealthy, and the current situation appears to be a once-in-a-generation opportunity to multiply your wealth many folds. Because the rich usually get richer in bad times, an anonymous saying goes that riches are made in recessions, and looking at today's economic situation, it appears obvious that a similar opportunity is knocking on the door again. But opportunities don't last forever, so let's look at the story of the day. If you look at the recent headlines, you'll notice that 9 out of 10 CEOs are preparing for a recession. All CFOs are cutting costs by 10%, while JP Morgan warns that the stock market could fall another 20% from its current levels. Although it may sound negative and depressing, recessions occur on a regular basis. If we use the scenario correctly, we can be set up for the rest of our lives to take advantage of incredible deals and discounts. According to the legendary Warren Buffett, bad news is an investor's best friend. So let's talk about what's coming up in the next 12 to 24 months. Typically, recessions are characterized by a significant increase in unemployment, a decrease in wages, a loss of consumer confidence, and a decline in the value of almost everything, including stocks, energy, food, and services, with certain effects persisting for an extended period of time around the world. Second, recessions reduce corporate earnings. Recent quarterly earnings have shown slow or negative growth. Earnings compression and job losses amplify the impact and trigger layoffs on a larger scale. The cumulative effect results in a massive reduction in aggregate demand, as evidenced by dozens and dozens of companies laying off workers. According to the Bank of America, approximately 175,000 jobs will be lost in the United States each month. So, what does all of this mean for your investment, and how can you profit from it? Let's start with the stocks. All three major indices have fallen by up to 30% this year to date. According to JP Morgan's analysis, these are expected to fall another 20% from their current value. Since 1946, we can conclude that the maximum bearish values were 30%. The worst was in the fall of 2009. It was when the S&P fell 57 points from its peak. When the average and the recession are combined, these bear markets dropped to a level of 34.8% on average, and markets are currently down around 25%. It is commonly assumed that the absolute bottom has been reached when we see investors retreating everywhere. This is the point at which things begin to improve and time to recover. Let us discuss real estate. It's true that each area is unique, and some areas may continue to have thriving housing. National declines, on the other hand, are extremely rare. There have been very few occasions in the last 60 years when prices have fallen by more than 10%. According to Wall Street consensus, national housing prices will fall by 7%, with the worst declining ranging from 10% to 15%. Every market will react differently if interest rates continue to rise. According to Moody's, the most vulnerable markets could see a 25% drop from their peak. This includes parts of Idaho, Florida, Arizona, and Southern California, where the decline lasts about a year and a half before bottoming out. This will make a little difference to people who have fixed mortgages and plan to stay in their homes for the next 5 to 10 years. On the other hand, if someone wants to invest in real estate, we can expect to see certain deals, which we'll go over shortly. The third factor is money. The common belief is that cash serves no purpose other than to rot due to inflation. However, when asset prices are falling, cash may be the safest place to keep one's wealth. When a billionaire like Ray Dalio agrees that cash is no longer trash, the statement takes on new meaning. People may have forgotten, but cash was the best performing asset in 2018. You would have outperformed the market if you had saved your money in high-yielding savings accounts. Cash is without a doubt becoming an important component of a portfolio. Fund managers are holding the most cash on hand since 2001. Similarly, Citigroup has stated that cash is the only option available to investors as a recession hedge. So, how can you make money out of all this? Why do people usually fail to capitalize on what is just a turn around the corner? What you need to know is as follows. The first benefit of a recession as a once-in-a-lifetime opportunity to build wealth is that everything will be less expensive. When a person believes that now is not the time to invest because everything is falling by around 30%, a wealthy person sees an opportunity to buy everything at a 30% discount. Warren Buffett shared the perfect analogy, saying that when hamburger prices fall, we sing, and when they rise, we cry. Except for stocks, everyone thinks the same way about everything. When stocks fall in value, investors can get more for their money. However, they are no longer popular. As a result, you must reframe your thinkings so that even a failing market can benefit you. The second advantage is that there is less competition. During difficult times, businesses cut back on expenses to conserve cash and keep it safe. On the other hand, it allows smaller, more aggressive companies to step forward and take their place. According to one study, among 16,000 companies, those that continued to advertise increased their wealth and grew with positive growth at the end of the recession. The third factor is increased opportunity. The recession is, in some ways, the market's way of weeding out the weak and providing opportunities for new, smaller businesses and people to develop. Patrick and David made an excellent comparison a few months ago. It's like a forest at its peak, where only the tallest trees receive sunlight. As in our markets, this means that only established businesses have access to resources. But, like a forest on fire, our economies have a way of bankrupting the giants who can no longer sustain themselves and allowing smaller businesses to thrive and develop. The fourth point is that every bear market is followed by a bull market. According to Yahoo, the S&P 500 has fallen by an average of 29% during recessions. However, the stock that reached its lowest point returned 40% the following year and 58% after a few years. This implies that investing when things are bad is more profitable than selling when things are good. In the long run, markets always recover. It has occurred throughout history. The fifth requirement is that you act before anyone else does. It's much easier said than done. It appears safe to invest during recessions, but recessions are never confirmed. For example, the Great Recession of 2007 was not officially declared until December of 2008. We can always find the recession right before it ends. So, what are our options? First, you should monitor your market, cut unnecessary expenses, and run a lean operation. Continue to reinvest as much as possible into the market. You should also have a backup plan for what to do if your investment drops from 20% to 50%, how you'll make up the difference, and if you can potentially take preventative measures ahead of time. Second, you should keep some cash on hand. One must have a firm belief that while money is best used when invested, one must have peace of mind when cash is on hand. Depending on the time of year, an investor should always have 15 to 20% of his or her portfolio in cash. This allows investors to seize good opportunities. Third, you should safeguard your career. This is something that will serve you as your best insurance policy regardless of what happens. The worst case scenario is not that the market falls, but what the market falls and you lose your job at the same time, with the investment selling off before it has time to recover. This is the best time to learn new skills and double your existing ones. A 5% allocation to Bitcoin, for example, could have increased a portfolio's return by 65% since 2014. Fourth, only invest for the long term. Generally, it's not best to invest any money that you will require in the next 5 years. The best way to invest is to do nothing different than what you normally do. As seen and observed, dollar-cost averaging or buying at regular intervals is one of the most profitable long-term investment strategies, so stay in the market and keep buying. Fifth, diversify your investments. If you can't handle a 20% drop in price, chances are you've invested too aggressively. For example, if you've invested in US tech stocks, you should consider investing in real estate, where rents appear to be more stable. As a result, your portfolio will be more stable and less likely to collapse. Hope you liked the video. See you in the next one.